Everybody. That music means we are back. Not on our usual Tuesday time slot, but on a Wednesday, a rearing to go Wednesday. A lot of great content coming at you here today, listeners, because it's a fun day. It's a celebratory day here on the pro side because we are about to embark on Pro Q&A session number 100. Yes, hard to believe. We are already at number 100. Seems like we just started these just a few months ago. And yet, here we are already at episode 100. So we thought, how could we celebrate this pivotal milestone? And you know what? We hit upon two very, very, very compelling celebratory items. First off, we have to welcome back the Oracle of New Hampshire himself, Mr. Matt Amberson from ORATS. After all, he was our first guest on our very first Pro Q&A session. So it made sense to make the circle complete and bring him back for episode 100. Then on top of that, because we love you folks, we thought we'd give you a sampler, give everybody a taste of the fun that's going on here on the Pro. So right now, live, if you're over there on Twitter, you'll see the link out there. Just click on that. Come right on in to the fun here today, and today only pretty much, but today nonetheless, you get a good taste of what we have cooking here in the Pro. So we do this pretty much every week, listeners. We bring on another great guest from the world of options and derivatives and allow our Pro members to have free reign. Whatever questions are top of mind from them get to be answered here first and foremost. We've gone deep on a lot of great, crazy stuff. We have obviously 99 already in the can, so if you join up now on the Pro, you can go back and access all 99 of those. So you're talking 99 hours worth of content right there. And then, of course, on top of that, every Friday, we also do Options Oddities. It's usually myself and the Rock Lobster. Actually, Matt joins us occasionally there as well to talk all things unusual activity. So we hunt for the most interesting, most intriguing, unusual trades of the week, and then maybe sometimes we talk ourselves into doing some of them, which is always fun. So that's a lot of fun, as well as you get early access to a lot of other shows we do here on the network. For example, our Pro folks right now are getting a lot of the OIC content we recorded. It's all heading out to them first before it goes out to the network, as well as, of course, live access to everything we do, as well as, of course, giveaways. So if you guys want to join the party, see what it's all about, theoptionsinsider.com/pro, the place to go. And like I said, joining me today, back in the hot seat. It's been a while. We haven't chatted with him really since Pro Q&A 77 back on November 15th of last year. None other than the Oracle of New Hampshire himself, Mr. Matt Amberson from ORATS. Matt, welcome back to the Pro Q&A hot seat, episode 1, a few in between, and now episode 100, sir. How does it feel?
Yeah, it was an honor to be on 1, and it's an honor to be on 100. And it's great that the people, you've opened it up and the people can come in and hear all the great content. I know I'm always searching for content. Even, I've been an expert and been in the options field since the 80s. And so, but I still like to learn, and I'm sure all your clients are hungry for this content. So kudos to you, Mark, for seeing all these things and encouraging us to set up these reports, whether they be the earnings report or now that I'm on Option Odyssey, the unusual volume reports. That's a lot of fun to be on the oddities. Some really neat things that you wouldn't often see, but looking at unusual volume, I mean that's usually in the option market where things are happening. So that's been fun to do. And like you said, maybe we find a trade every now and then. So good to be here, Mark, for 100.
Yes, we're luring you to the dark side slowly but surely. First, the earnings data. Now we're luring you to the dark side of unusual activity. Who knows what will be next, Matt? Where we will lead you. What dark rabbit hole we will lead you down next, sir. But yeah, it's hard to believe you haven't been on the Pro Q&A since last November. So we haven't even talked to you in the Pro Q&A this year, which is crazy. So let's start there. We started the year with a lot of our guests kind of getting their sentiment and their outlook for the year. Obviously, now we're coming into, it's hard to believe, we're almost closing in on June, almost closing in on halfway through the year. So I know at the start of the year on some of our other shows, Matt, you had a bit of a dire outlook, dire prognostication, including for this earnings season. Things have been, let's say, interesting. Obviously, start of the year, we had more rally than people expected. These days, we seem like we're glued around this 4,100 level out there. So right now, looking back on the first 5 months and change of the year, how is this unfolding versus your expectations?
Yeah, I mean, obviously, I've been bearish But always keeping in mind that the markets can remain irrational longer than most people can remain solvent, or something like that. And so, what I've been saying is like, listen, if you're buying this market, you're getting in at PE multiples that are pretty silly. I think they're pretty high. But the hard thing is, how do you position yourself, and what do you do? Well, I've been saying it probably since November, is you have to have these way out of the money puts, I think, but not have too many negative deltas. So you got to be selling some tight put spreads so you don't lose too much, but you keep some deltas. Watch the signals. We've been fortunate. We have our internal ORATS meetings, trading club meetings, and watching. The signals this week are bullish. So, and the market's kind of looking like it right now. What we look at, it's no secret. We look at, the falling implied volatility is bullish. Rising contango is bullish. That means the front month is going down relative to the back month. And we have these forward volatility relationships. When they get pretty stable, that's pretty bullish as well, and they've been stable. So, and we were a little bit bearish for that downdraft a few weeks ago. So, what we're doing is, or at least what I'm doing for my own portfolio, is there are a lot of good places to get returns out there. It's driving the banks, especially the regional banks, crazy because they can't really offer these 5% rates that you could get. So, you park your money in bonds, or you park your money in some money markets, and you could get a pretty good return. I'm underweight equities, overweight. I have puts in my. I think puts is an asset class. It's really the only thing that's truly negatively correlated when it comes down to it. When the market's just getting whacked, even gold. People are selling out of gold to cover margin, and so crypto as well. So really, puts are really the only negatively correlated asset in my book. And you could even argue that VIX is not, even though, typically it does go up. But, like I've been calling, I think this is going to be a well contrived slide if we get it. I think that a lot of people are already positioned for their bearishness, and that's what's kind of buoying the market. Wall Street climbs a wall of worry, and I think it's true here. But at some point, it's going to get a little bit too ugly. The Fed's going to break something, raising interest rates. They're not even near their 2% target. So the Fed's fighting against the market. And you got to listen to them. I mean, they're saying that we want to control inflation, and inflation's kicking up. And, it's still there. So, as a matter of fact, the market usually, and the recessions don't usually come till the Fed says, we need to start lowering rates. But I don't really see that for a bit. So, my outlook is definitely bearish, but you have to be very careful, and you have to be, not too short, but you have to have your puts in position. You have to, and when I say position too, we're not just long puts, we're long way out of the money puts, and we're long put calendars. So what those are, you're selling some puts against buying some puts. So as the market goes down, if you look at the payoff of a calendar, it's like a tent, and the tent, the apex of the tent is at your strikes. And so if they're out of the money, you want that market to drift down, which I think it's going to do. I don't think this is going to be a going down by the elevator up with the escalator. I think it's going to be going down with the escalator. It's going to go down slowly. People are going to realize that the market's overvalued. They're already positioned well. So that's my outlook, Mark. And I'm still sticking with it. I think the PE ratio should be, especially in a recession, which I'm counting on, is supposed to be something around 15 or 16, and I think we're up at 18, 19 almost in the PE, which is way high. So you can't get too bullish here. Short term, yeah, we put on some trades that we'll talk about later that are pretty cool around the some intermittent bullishness, but like long term and overall, pretty bearish, Mark. So that's how I stand.
All right, a lot to unpack there. I see the people starting to filter in there. If you are new, remember you can put your questions there in the live chat. We got Nichols. Congrats on 100th episode. Thank you, Nichols. Yes, I don't think you've been around for all of them. Maybe pretty close though. You've been around for quite a while. So thank you for listening to most of those 100 pro episodes, as well as, of course, all of the options oddities. I don't think we're quite at 100 with options oddities, but pretty darn close. So yeah, you're talking nearly 200 episodes of official content, plus all the pro early release stuff you put up there on that pro feed. So that pro feed, pretty jam-packed with content. So if you need extra options content in your life, and a lot of it is indeed evergreen, which is always fun, then check it out over there on the pro side. Matt, you kind of touched on this with your kind of first answer there, but this first question comes in from Hedwig, and he wants to know, how is your guest positioning in his portfolio for the second half of the year? You kind of mentioned it. You got some cash and money markets. You got some puts. But before you go any farther, let me just provide some context for your answer, because we asked this exact question to our audience last week, as was our question of the week. We said, quite simply, in these troubled times, where are you allocating the majority of your portfolio? Gave you 4 choices: cash, crypto, equities, or commodities/fixed income. Yeah, I know we had write-ins for Vol. We had people asking, why are commodities and fixed income the same? Don't blame us. Blame Twitter. Only 4 slots. But at the end of the day, this is how you folks voted. 45.6% said cash. So you're kind of feeling what Matt was putting down. And quite frankly, a lot of our guests in the pro Q&A hot seat, I think the majority of the ones we polled recently have been in cash or some equivalent. Not a ton out there really riding high on the bullish side, but intriguing nonetheless. 32.4% for equities, 19.1% for commodities/fixed income, and bringing up the rare 2.9% for crypto. So, Mr. Matt, maybe let's start there. Are you surprised that so much of our admittedly pretty savvy audience, even they, are sitting in cash right now? And then B, again, you said you kind of touched on this, but do you have anything else you want to add for Hedwig and the rest who want to know how you're positioning right now? Have at it, sir.
Yeah, that does look like a big cash number. Anytime you're getting near 50-50 in cash, the people that's quite a bit. Crypto, so I run the permanent portfolio on a bunch of on my assets, so I don't have to look at it. And there's a fund, and it's done well over, the past, 10 years or so. So that's 25% cash, 25% equities, 25% gold, 25% fixed income. And then when I do a permanent portfolio, I throw about 5 to 10% crypto in there. So I'm surprised crypto is so low.
I was just going to say, where's your Solana allocation, sir?
Yeah, no Solana, just Bitcoin actually. So, again, that's my kind of overall thing. And then in my trading accounts, like I said, I have a lot in puts. So not a lot of money, but the notional amount is covering a lot of my especially equities. But I think, like I said, everything's going to go down. If we go down hard, everything goes down. So again, I think there should be a put allocation, and you have to be careful. The strategy is not just a long 30-day 30 delta put. You'll get killed. That's 5. It's going to cost you 4 or 5%. In our back testing, but if you're doing way out of the money puts, maybe that's 1 or 2% a year that you're draining out. But if you're doing these calendars, you could get it under 1%. So my insurance isn't that high. And again, I'm watching signals, and we're trading around. We have a lot of great signals. We have a signal tied in with our back testing, signal tied in with our alerts now. So we're able to see what's going on and trade around it pretty efficiently. And so, like, for example, that's where, today, we're saying, okay, well, it's bullish. So we're looking at some strategies, not terribly bullish, but some calendars some diagonal call diagonals. I've actually lately, it was almost by accident, but I'm doing my long is more in the money than my short. And you might say, well, that's a lot of premium, that's a lot of Vega, but it's actually kind of working out. So I have a $5 differential, and I have some calls that are out of that are slightly out of the money, and then that I'm long, maybe 2 or 3 days, 4 days, 5 days, and then I'm short the 1, 2, or 3 day, slightly more out of the money, but you could still get some decent premium if you just not 0 DTE, but 1 day, 2 days. There's a fair amount of premium, and that comes in really quick on a 0 DTE. So that diagonal has actually been working pretty well. So so to answer Hedwig, my positioning is pretty typical permanent portfolio for most, having some puts, having a little bit of crypto, and then playing the signals. Like, we're bullish, so we're gonna play a little long, and we're gonna have some short put spreads in there, tight ones, to kind of counteract the bleed that we have on the put calendars, some of the put spreads and straight puts that we have way out of the money stuff, really long term. So that's how I'm sitting, Mark.
Interesting. That diagonal is interesting. It doesn't make it prohibitively expensive to do the diagonal by structuring that way.
In the SPX, you could do it for like $500.
Okay.
Between $500 and $600 for and it's really, yeah, I know. It actually makes you think, because I'm saying, okay, well, it's $5 wide. A put spread or a call spread that's $5 wide could only get to $5. However, the diagonal, and getting time on it, I sold one the other day for $10.50, and then we have this new trade history. We just released it. I don't know if you got the email, but we have this trade history analyzer. So I went back over that trade every minute, and it got up to $12. I mean, if can you imagine, like, it's $5 wide. Granted, it's a diagonal, and that got up to $10, $12 wide. So, and generally, if you buy them out couple days, they're like I said, $5, something like that in the SPX. So yeah, it is. You take a look at it. It's a strange trade. I've seen it once. Someone had it. I just remember on watching a YouTube where they did that. I go, that's kind of a weird trade. And then I kind of did it, and then I said, okay, I gotta watch this thing. But they're doing okay right now. Yeah, so take a look at the diagonal where you're long and slightly more in the money, which you would think it would be counterintuitive, but it's actually working all right, Mark.
Yeah, it doesn't immediately leap off the page as that's what I want to do, but it's intriguing. I'll have to check that one out. Intriguing. That's why you tune into the Pro Q&As, listeners, for intriguing nuggets like that. Let's keep rolling here. Let's go out to Seymour. Let's go to Seymour. He wants to know, is Matt surprised that the current earnings season isn't as disastrous as he and many others anticipated? Yeah, we were talking at the start of the year, Matt, on some of our other shows. We had Q1, maybe it was a bit of a question mark, but it seemed like you and a lot of people were really just pretty much fixated that season 2, the cycle we're in right now, was really going to be kind of a bit of just a disaster. It hasn't been terrible. It's been kind of mixed. I think people are playing the game pretty well. They're doing that whole, beat down expectations so they could clear that much lower bar. But as Seymour wants to know, are you surprised that the current earnings season isn't as disastrous as you anticipated, sir?
I am. And first of all, these questions are great questions. So your pro listeners are quite insightful, and they have good memory, which is great. So I thought, and actually what's happening too, we've come down, depending on how you look at earnings, it was up around almost 250 for the S&P. Now, I thought it would come down about 20%. So that's like between 200, 210. It has come down, but you're right. I think a lot of the companies are managing expectations pretty well. And I also think that a lot of the mega companies have kind of done better than people have thought. For example, especially the banks, they got a windfall with all these regionals going out of business. So the big banks did all right. And the Apples and Metas and all that, they're getting their big government contracts and such. So they're and Microsoft, they're doing all right. But now we're coming into retail. Target did okay, but actually, if you look at a lot of the numbers were poor, and then Home Depot really got smacked. They were poor, so I think the consumer is weakening. I think we are going to see a recession. It's been put off pretty well, and kind of kudos to the economy itself. It's just kind of bumping along, and everyone's kind of looking at each other. It's like everyone knows it feels weak. Real estate is just ugly, especially commercial real estate. And then people are waiting for the shoe to drop. I think most people that have seen these before, that it takes a little bit longer than your expectations. So I'm still fully expecting there to be earnings problems, which we actually are seeing. It's just not as evident in the volatility, and high profile names are not getting whacked like we thought might. But yeah, I am surprised that it isn't worse than expected. But I think you bring up a good point. Everyone's kind of expecting bad. And so if you get slightly good, like Target today, it kind of goes up a little bit. So, it's all about, inflation's all about expectations, and I guess earnings all about expectations too. But, you can only keep these hot potatoes in the air for so long before they start burning people. And I think that's going to be pretty soon, Mark.
All right, let's go out to the live. Let's go to P&L Man. He says, Matt, I want to write some 3-month options. Should I wait a few more days to take advantage of increased volatility around the debt ceiling drama? Yeah, that seems to be why we're rallying today. Of course, at the end of the day, more buyers than sellers out there, but it does appear to be some hope, some rays of sunshine in the debt ceiling debate. It is always terrifying, Matt, when our nation is in the grips of pretty much in the control of a bunch of staffers trying to debate this stuff amongst each other. The head people don't meet until the staffers are done. That's always good for the future of our nation. But yes, they're saying there is some progress on the debt ceiling. P&L Man wants to know, he wants to write some 3-month options. He doesn't say on what. So if you have a particular underlying you like, make sure you let us know, P&L Man. But he wants to know if he should wait a little bit more to take advantage of a bit of what he assumes will be a debt ceiling volpopser.
Yeah, that's a tough one. I don't like to write naked options. I would suggest him just looking at a little bit of protection, and you could even again get a shorter term, just something to protect yourself. So I don't like the naked writing naked.
Yeah, I'm pretty sure he usually does covered calls. That's what he's asked about in the past. I'm assuming these are like covered call type trades.
Right. Yeah. So again, I think you're playing with fire. But I think in the short term, the market looks bullish. Again, I think that there's a circus going on in Washington now. It pains me to watch. So debt ceiling, and they kind of build that up. So I watch the markets a little bit more. The markets the volatility is very low, and the actual volatility is low as well. So when you write, it seems a little cheap right now, the vol, to me. When you want to write, there's blood in the streets and the market has just fallen. So, I think I'd wait for a little bit more pain if we get a knee jerk down, if something happens. There's a lot that can happen out in the markets and the macro environment. Powell's going to speak on Friday. There's going to be an option X is also Friday. So, I'd be inclined to wait a little bit if you're writing. The vol's pretty low, markets are kind of high. I'd wait for a little bit of a correction before I do that, Mark.
There you go, P&L Man. Interesting question. Remember, if you folks have questions in the live, get them in there in that chat, just like P&L Man and the rest did there. Let's go to Meats, Mr. Meats with a Z, another long time listener. I believe he's been here for Pretty much all 100. So we love all of our old schoolers here. Mr. Meats wants to know, where does Matt fall with zero DTE trading? Also, where does this end? Obviously, there is interest in them, so the brokers and exchanges will follow the volume. But how short is too short? Well, we'll be talking about 5-minute contracts at this time next year. What is the practical limit to these things? We kind of touched on 0-day earlier. You and I have talked about it on other shows as well. So I know you're a fan, but maybe for Meats and everyone else who hasn't maybe heard some of those appearances, maybe lay down now, where do you fall on the whole 0-day trend, I guess you can call it? And then B, Meats also wants to know, where do you think the practical limit of this stuff is? Are we going to be talking about, sub 1 hour options in a year or two?
Yes, yeah, another good question. So zero DTE, where to fall? Yeah, I think I think it's great. It's been great for at my heart. I'm a finance major, master's in finance, and I want to see what the market thinks about time frames and relationships, and it actually helps people in finance price companies, price debt, price the risk in the market. So the option markets, people say, it's just betting. They don't really know. This is a very good thing that we have, and it's making finance a lot more rational, structured, important to the overall economy, business decision makers, et cetera. So I think it's going to go down to hourly, could be half hourly. If you think about Powell, they do the FOMC at 2 Eastern, and then they do the press conference at 2:30. You could see how much the market thinks the market is going to move during that time, and I think that's important information for people. And people are saying, it's just gambling. That's so short term, but a lot happens in short term data. Companies are going down to short-term, credit card information and making decisions based on that. So there's a lot of information that's super important that can come out of intraday expiration. So yeah, maybe not 5 minutes, but I would think half hour, probably hours. I've been talking hours for a while. And then while I'm at it, the zero DTE, I think is a boon for market makers too. What happens is, as a market maker, what you hate is you have these kind of structurally formulated positions on that you're taking the other side. So most people are maybe buying puts, or at least big banks are buying puts for regulatory and other reasons, and you're getting a lot of calls. So you're long the upside and you're short the downside. Well, zero DTEs allow you to quite quickly hedge that downside, for example. And there's so much liquidity that you don't have to take it down so much, because there are a number of market makers and a number of big players in there that'll take down some very good size. As if you could see, just an incredible amount of notional is trading in the zero DTEs, and that's actually super helpful for most market makers. That they're very nimble, and they could expect, a lot of volume, and they could expect the ability to be able to hedge out their kind of structural books. And so I think it's been, very helpful, and it's actually been, I think, it has, suffocated the volatility in a sense, at least taken away a little bit. But so I'm a fan of the zero DTEs, and I think we'll see probably hourly tomorrow.
Yeah, it's so funny. Just not too long ago, you had most of the big exchanges were pushing back against all things even remotely related to binaries, right? They were seen as the den of iniquity in the world of derivatives. They were the shady part. And now CME has event contracts. All SIBO and everyone else have these 0-day contracts, which aren't quite binaries, but they're kind of a half step towards them. And now we're talking maybe hourlies down the road. That certainly does have a lot of binary characteristics to it. So yeah. We're heading down that road, I guess, Matt. It's inescapable at this point. They're going to go where the volume is. They are for-profit public companies at the end of the day, as Meats points out. So intriguing stuff here. Let's keep on rolling. Let's go out here to – who's next? Let's go to Pete 05. Here we go. This is along the lines of what we were just talking about here, Matt. He wants to know what strategy back tests the best for 0-day trading. Is it just as simple as selling credit verticals all day? You talk to exchanges like Cboe and others who handle a lot of this flow in their SPX product. They've been telling me that this is some of the most symmetrical flow they've ever seen, where they're seeing, a lot of spreads going up. There's not very little bias in one direction or the other. So it seems like the audience is liking a lot of that kind of vertical action. But Mr. Matt, you're out there crunching the numbers, which is funny to say in and of itself, running a back test on a one-day trade. But that's where we are now, Matt. So Pete, and I'm sure a lot of our other listeners want to know, what back test the best when you've been looking at these?
So, back tests, anyone, there's not a lot of alpha in just, saying, hey, do this or do that. Where there's alpha is when you start looking at, well, why should I do that? And what is the timing for it? What is the current environment that we're in? I mean, that's what we're concentrating a lot of our back testing on is, is vol rising? Is vol falling? Are the volatility measurements more bullish, i.e., IV falling, contango going up, which means the front month's going down comparatively. By the way, we also have a 0 DTE measurement like the Cboe. So it was interesting that they came out with that. So we look at that as well. That relationship is important in back testing. So it's not as easy as what strategy is good for 0-day trading in general. What we're going to get to is what strategy is good for certain environments. And the definition of the environments, the important things that we're seeing in the environments are, for the underlying, just simply moving averages. Where is the stock versus the moving average? As far as signals for or environment definitions for volatility, of course, the 0 DTE versus the 10-day constant maturity are things that we look at. How is that relationship? The higher it is, the better it is for selling. Meaning, if the 0 DTE is high compared to the 10-day, that's better for more aggressive selling. And the opposite is true as well. We also look at we have a one-day historical volatility. That's we look at that direction. So what that means is, yesterday's volatility is important. One-day volatility is important. The reason we could do that is we have this modified Parkinson calculation that uses intraday volatility, because most volatility you're going to need to at least use 3 days, to get a 2-day close to close. But if you use a modified Parkinson, which we've tested out against our old method that we used to actually simulate scalping gamma and turn that into a volatility. But we found that the way that we modified the Parkinson was close enough to that to make it, not beneficial or cost effective for us to have to go through that very expensive calculation, because we had to download all the tick data for every day and simulate trading against it. So I know this might be a little bit technical, but what you look at is how much the market's moving. That's a historical volatility. You look at what the implied is versus other constant maturities. So the 0 DTE versus the 10-day IV, and you look at direction of those. I watch all day that direction, and we're constantly coming up with signals: get in, get out, so that type of thing. So it's not just one strategy. However, one of the things that I found is kind of early-ish in the morning. So I would say 10 o'clock or so. There are often some opportunities to sell like way out of the money verticals that might be 20, 25 wide. And you're risking about, it's about a 10-to-1 risk. So, but the win rate in that, I think, is greater than the loss rate. And if you're, if it's market's going against you, you get out, but those are, I think, a lot of where there is still some edge in the market is, and kind of earlier when there's, the market would have to make a big move in order for that particular strategy to lose money. And then if you get later in the day, and especially currently when the markets have not a lot of premium in it, you just can't sell. You're not getting enough premium in order to sell it. So if you were just going to look at a strategy, I would look at kind of a time and get as far out of the money as possible. Do it as tight as you can, and those are, and then just have your stop loss or have some signals, and then get out with a certain amount of profit. And that's been pretty successful for our testing and trading, actually. So that's what I'd say to that, Mark.
Interesting. Early morning, out of the money verticals. Got to get the early bird gets the worm these days, quite literally, out there in 0 day, which means I will miss all those trades, Matt. I am not an early bird anymore. I'm a late night bird. I'm the other way around. I'm a night owl. All those years of going to the SIBO crazy early burned the early bird out of me. I'm done. All right, let's go to, since you're just talking about the 1 day measures of vol, let's jump to this question here from JLS because it dovetails nicely. JLS wants to know quite simply, what does Matt think of 1 day VIX? Matt, this has been all the rage. SIBO launched this a couple of weeks ago. Some folks love it. Some folks hate it. Our audience was surprisingly indifferent to it. They thought it was kind of not really a meaningful indicator for them. I think around 3/4 of our audience came in on they weren't really planning on paying attention to that. So that kind of surprised me. Well, first off, give us your thoughts on 1 day VIX, maybe what you like about it, what you don't. And then you said you have your own measure. Maybe how does that compare or contrast to what the SIBO's doing?
Yeah, so we use the what most people use is implied volatilities using binomial, and then we have ways to solve for futures contracts, and we use a bunch of out of the money calls, out of the money puts, and we draw kind of a smooth modified cubic spine through that, so we get a very good volatility. And what most people are expecting, if you're looking at your trading application, you have a certain volatility that you're looking at. We do that all through the day. You have to be able to tick down the day, meaning we start at 95% of a day at the open and go down to 5% of the day at the close, and kind of a straight line through there. So it's a little technical, but that's we have a minute by minute basically VIX. I think that's how the SIBO does it. I think that they're updating it all through the day, so it's not just a 1 day VIX. It's just it's constantly looking at the 1 day volatility. So you have to but the way the VIX calculation does its thing, it's kind of strange to me. So I haven't looked at it that closely. I know that ours, I think it is important. I would venture to guess that the VIX works decently well. Again, the way I would use it is the relationship between the 1 day VIX and like a 10 day. I don't like 5 day because you kind of get these calendar. If you get too many weekends in there, but so we compare it to our 10 day to get a feeling for what is that ratio, and then we're testing that ratio against certain strategies. So I think in general it's good. Again, the VIX calculations is not that coherent to me. That's it's a little strange to me. Most people are using binomial methods to figure out implied volatilities. So that's the one that I look at. Mine matches what's in the market, and so I could go trade it. Whereas a VIX, if you go look at the SPX, and after looking at the VIX, you're like, what does this relate to? So, so that's how I'd answer that question, Mark.
It seems like a lot of people take issue too with the fact that once you get around noon in the session, the SIBO is looking primarily at the next day's options more so than that same day's 0 day, which I guess is kind of a bit of a necessary evil when you're looking at options that go away so quickly. But I think that rubs some people the wrong way. They don't want to see all those next day options in there as well. They want to kind of just focus on what is implied, right? So that seems to be a bit of a sticking point as well. Do you guys do something similar with your measure?
Oh yeah, we go all the way to the last minute. So there's still premium And so you could still, and we tighten it up, and we know that there's a certain amount of percent of the day left. As long as you're consistent, I mean, that's what you should be doing. So yeah, skipping to the next day. Again, that's you're not going to be able to look at the SPX because you're trading 0 days, right? So, but you're not going to be able to compare it. So I think it's a good thing to in general, but devil's in the details on this calculation.
Yes, as with all things VIX, the devil is very much in the details. Let's go back to some of these other questions. We leapfrogged here to get to JLS. Let's go back to Stego. We had Option God saying, congrats. Well, thank you, Option God. It has been a fun run. A 100. Option Queen, congrats. Thank you, too. Remember, if you guys got questions in, get them in the live now. We got a lot of people who got in ahead of you here via the early questions. But if you have some live questions, maybe we make sure we bubble those to the surface here as well. Let's go to Stego. Stego says, is it even worth it trading? I think it just means, is it even worth trading butterflies in short duration contracts, or do the commissions make it not worth the premiums collected? So it sounds like he's looking at some 0-day flies. I have seen more than a few people write in about 0-day flies. On the surface, it sounds like nonsense, but a lot of people are writing in about it, so it's intriguing nonetheless. Sounds like he wants to do short flies too, so he wants to collect some premium, and he wants to know, is it even worth doing it, or do the commissions wipe out any potential premium you could get, Matt? Have you been doing, you mentioned out of the money verticals, have you done any back tests on flies in 0 day, sir?
Yeah, we have. We all have our favorite strategies, and I should be agnostic, but I can't get flies to work for me. I just, at some point I'm going to have to just find a good fly strategy. And it seems like 0 DTEs would be good because, you're trying to, if you're long it, you're trying to pick a strike where it's going to go to. And some of my friends are using, these charm and gamma weighted things, to see where the market is likely to end up. And they're using that with, with flies. And I know there are some people out there that across the internet that are using flies, short-term 0 DTE flies. Again, I haven't had success with them. I've tried them. We've backtested them. They don't particularly backtest that great. I know there's a lot of other, if you watch and read about some of these people that are successful at it, they have, a lot of these rules and such that are a bit complex. The short fly is tough. The great thing about the SPX and the indexes, though, is you don't have to worry about getting exercise. So you could put a fly on and just let it sit there till the very end. So it's kind of nice. One of the things I could say, though, is when I'm using a fly, as it goes by the fly, that's when I take it off. So if it gets near it, I don't get greedy. I take, I usually do an out of the money fly, and for cheap, and then if it goes by it, take your little bit of money and get out of there. So that's tested, okay. And that's the way I play it on certain days when I find out that when I see that the flies are pretty cheap, I'll put them on again. Like recently with a vol this low, you could get a fly on, and then the market's moving a decent amount as it goes by. You should be ready to take it off. I don't use a price exit or a profit exit. I use a near the money exit. So if it's right at the money, that's when I take it off. So that's just my advice on those things, Mark.
There we go. Let's go out to Twitter. This is what we were talking about a few minutes ago, Matt, about the best time of day to trade 0 days. And you said early in the morning as well as right towards the end of the day. And we have, looks this John Tate. He's agreeing with you, but he says the last 2 minutes are pretty good for him. So he's going right up to the wire. Have you gone all the way to the last 2 minutes, Matt, in your 0 day trading?
I think I've done everything. I actually, especially when you could get these puts for super cheap, and even a put spread for very, very little in terms of SPX notional. and they'll hit it sometimes. So I've had some of my best trades are very close, and I'm watching the seconds. So yeah, like that's with just a little bit of time left, you buy it out of the money put spread for very little, 10 cents, 20 cents. And, all of a sudden you'll see a pop in the market. That's when, buyers, imbalances, who knows what happens near the close. But I think that I agree. I mean, I think that, there's some opportunity in that time space.
The old gamma bombs, they're exploding right at that moment. So
yeah,
if you can dodge
absolutely.
the explosions, you can get some good trades off. Let's go out. Actually, already come up against it, man. Time flies when you're having fun, Matt. Let's go out to Wolfpack. Wolfpack says, Matt has said in the past that you should sell covered calls as far out of the money as possible since they limit the returns of the underlying stock. Should I take it from this that you just shouldn't sell covered calls in a stock because they limit your overall returns? Now, Matt, I think he's referring to in the past, you have said in your back tests when you're looking at covered calls, the ones that perform the best are the ones that have the farthest out of the money strikes because the underlying stock is the big driver of returns at the end of the day. So is Wolfpack's reading that to say he just shouldn't bother with covered calls? Is that correct, sir?
Well, I mean, that's what our testing has found out, that it's rarely that helpful to sell these calls because you're giving up a lot. So what we also found was you have to get a high spread yield, which is the option premium divided by the stock. So you have to get a lot of money. You have to get and do it out of the money. Because again, the way stocks move, now if it's an index, it's different. But the way stocks move is some you see these weird statements about Apple, like if you take out the last 5 big moves in Apple over the past 5 years, the returns are negative, or something weird like that. So you can't give away a big move. I counsel then on either call spreads. So even if it is a big move, you're covered, or way out of the money, so you're happy if it goes up that far. So that's kind of my feeling on it, Mark.
Interesting. I make a lot of our covered call traders very sad there, Mr. Matt. Breaking hearts out here on the Pro Q&A. So we got time for a few more here. Let's go to, let's like this handle. Whenever you send in a question, we'll always ask it. Mean Gene, because I like your handle. Mean Gene Ashford. He's obviously down with our 80s wrestling trivia game every Monday on the option block. He says, is it still worth it to buy, quote, garbage calls in VIX and garbage puts in SPY? If so, how should I go about constructing these trades? Is there a specific percent out of the money or perhaps delta or premium range where these trades work the best? Also, how far out in time should I go? Are these 1 week, 1 month, or 1 year trades? Yeah, Matt, last year you and I were talking a lot about garbage VIX calls a lot. That was all the rage. Less or so garbage SPX puts, but there were some of those in there as well. Mean Gene wants to know if you're still intrigued in all things garbage VIX calls and then garbage SPY puts, and if so, how do you go about constructing them? Is there a range you like to set them up with, and also time frames?
Yeah, I mean, I'm using those less and less. What I'm doing now is more of the put calendars, just because I don't expect a massive move to the downside. I expect more of a controlled demolition of the market. So, I'm not using those as much. I do, if I see the VIX, like right now it's got a 16 handle, I'll start to look at some out of the money calls just to have them. And I give myself some time too. At least 3 months or something, and just get some way out of the money stuff. And again, they don't need to, the VIX doesn't need to go there. It just needs to pop one of these times, and those things will triple, quadruple in value. So those are the things that I'm looking at, Mark.
Yeah, you and I were joking recently that, garbage VIX call used to be like a 115, right? Now it's a 60 or a 50. So the range of garbage has changed quite a bit as well, which makes it interesting in and of itself. You see that 1x3 trade that went up in VIX a couple of weeks ago? I think it was a SEP 30-60 or 46, selling 1, buying 3.
Yeah, I think we talked about it. And again, I'm a fan of that. So
I think we did talk about that. You're right. Yes. So intriguing stuff out there. Speaking of intriguing, your questions are always intriguing. We'll see how many more of you we could squeeze in here, listeners. Then we got Boot Camp with Dan on deck coming up right behind you. We like you folks so much. We're going to give you a nice free live taste of that one as well, because why not? It's fun. Well, let's keep the fun rolling. Let's go out to Beeman, or is it B-Man? One or the other. They want to know, Matt has been running back tests for years. What surprises or tricks has he discovered that he thinks traders should know about? Well, Matt, when you're not talking to me, you're out there crunching back tests all day long. What surprises have you uncovered you want to share with our folks here?
Yeah, I think that's a really good point or question. That the big things that I saw that were shocking to me was, the market doesn't get the vol high enough and the market doesn't get the vol low enough. And what that means is when we're back testing, you would think of when the IV is super high that'd be a great time to sell. It's not. It's often the worst time because they just don't get the IV high enough to match the historical volatility at that time. So that's one thing. You can't just sell. You can't just sell blindly high implied volatility. So that's one thing. Another thing is you should try to identify certain signals for certain strategies. So we're getting much more into signals and much more into environments, environmental testing, environmental back testing, meaning, for example, slope is really important for verticals. I mean, you think verticals, out of the money verticals, you don't have that much skew risk, but there is enough, and it does impact the test. So, so find some signals, find some environments that you could test against. And our backtester allows for that, and just crank through, and you'll find, that's the way to find things that other people don't find, and that's what you want to be doing, as a trader is finding things that make sense, but a lot of people haven't found yet. So, that's a big thing. Obviously, the poor performance of the covered calls. Hate to turn the knife against the covered call people. The fact that the way out of the money puts actually work. That the way out of money VIX calls work if you have a good exit plan. So you have to be able to monetize, and often that monetization is quicker than people think. So those are the main things that I could think of that I've learned from all the back testing work.
Yeah, especially on the VIX side. You're right. We joked about that many times on vol views. You have not even hours, usually minutes, to capitalize on those calls before it's gone. So that's the challenge. People think they just buy those calls and they're good, but you got to be quick on the trigger finger to get out of those things. Since you're talking about lessons learned, let's jump to this one here from Mackenzie. She has a similar question. She wants to know, Matt has been scanning earnings for Options Insider for a few years now. Yes, he has. What are the lessons learned from crunching all that data we can apply to our earnings season trading? So, Matt, you're just talking about some of the surprises you've noticed. Anything particular to earnings you've noticed as you've been crunching all this data, sir?
Well, yeah. I mean, the biggest thing that we've learned, Mark, is that there's definitely a weekly bias. The third and fourth weeks of earnings are generally the most profitable weeks. So if you're long, those are the times to be long. And the rest of things, just trying to think, what they're, I like the calendars just like Passarelli does and during earnings. I've done some, we have reports that churn out the best calendars to do. Those timings are a little bit, technical, but, calendars work. So get used to calendars and do some back testing around calendars and earnings. And then also if you're long, stick to week 3 and 4. And it's, again, it's often counterintuitive. If it's high vol, don't worry about it. That's often those are, the times to get long vol. So those are the things that I've learned, Mark.
All right. We're coming up against it here. Let's see if we can squeeze in a few more listeners. Let's go out to this. I like this one from Max. He wants to know, is Auto available as a trade recommendation engine for traders? may be implemented into Tradier. So can someone go out right now, Matt, and hire Otto for their own trade recommendation purposes?
I love the question and love the reference to Otto. So Otto, our automation, and we are going to be, testing a lot more and publishing. We're running now almost billions of backtests. We've come up with ways to speed up everything, and we've bought these databases that are just incredible. So we're and then we're testing those environments. So we're going to have a lot more trades that we're going to be putting out there. And as far as where to put it, Trader, that's a good idea. We're obviously, we know Trader well. We're an RIA, so we could do a lot of things. So if that's the idea and there's some interest there, yeah, we're definitely interested in that, Mark.
A couple more here we can bang out. Then we got to hop on into Options Bootcamp. Keep Mr. P waiting here. Let's go out to Brian. He's got a twofer. He wants to know, is there a program or service for visualizing options pricing changes in real time that can be used for market sentiment? That reminds me of your old Acumen software, Matt. It wasn't quite that. It was more unusual activity, but it was a good visualization software. And also, can long-only leveraged ETFs fall apart the way SPXY did? So a twofer, sir. First off, if you know any good visualization software, have at it. Then he wants to know about, can long-only levered ETFs fall apart like SPXY?
Yeah, let's take the last one first. I mean, I think the sponsors are a lot smarter, but those still can fall apart. So, I'm often wary of those. And again, I have some very sophisticated clients over the years that would just take these apart and have such an advantage on me and others in the market that I shied away from trading things like that. As far as visualizing option price changes, well, of course we have a couple things. We have when you pull up a trade, for example, it could be even an iron condor or vertical or a single leg. We show what the price was yesterday and why it changed. So it's a pretty neat visualization. Was it delta? Was it gamma? Was it slope? Was it what was it? So that's kind of cool. And then we also have now we just released today and send an email blast out. Historical minute by minute pricing. You could go back anytime back, a couple of years. So you could graph things on that. You could graph implied volatility. You could graph our theoretical values. You could graph Greeks. So that's kind of a cool visual. And then we have a trade builder. You should check out our dashboard.orats.com for some visuals. Trying to think. Who else had some good visuals? I'll have to think about that, Mark. I'll get back to you. But, ORATS has our share.
Well, Mr. Matt, we'll have to leave it there. We're out of time, sir. But I appreciate you joining us for episode 100. Did you have a good time, sir?
Yeah, it's great, Mark. I appreciate it. Quite an honor to be the bookends at 1 and 100.
Mr. 1 and 100. No one can take that away from you, sir. It'll be on your
awesome
tombstone.
Questions. I mean, kudos to your followers, your clients, whatever you call them, your pros. Great questions, and it was a lot of fun, Mark.
Yes, it was indeed. You mentioned all the stuff you have cooking. If folks want to go check it out for themselves, where should they go? What should they do, sir?
Yeah, you can email me, matt@orats.com. Like I said, we're busy as we can be with exit alerts, with trade histories. We're coming out with a very easy way just to see all the backtests that we run, show you the backtests that we like. So that's going to be really cool. And then after that, we'll be working on implementing those, so you could almost automate those in our paper trading, and then we're connecting to brokers as well. So there's a ton going on at ORATS. It's a lot of fun.
Ton going on. Check them out, orats.com, ORATS.com, or Option Rats on Twitter, the place to go to learn more. We got to get on out of here, listeners, because we got the black-hatted one himself waiting in the wings. And you know what? Because we like you folks, because we're still celebrating Pro Q&A 100. We're going to keep the question-answering party going with a little bit of Options Bootcamp live. So you guys can join that one and have your questions answered live there as well. And that'll be starting live in just a couple of minutes, listeners. So stay tuned for that. And then, of course, we'll see you back here on Friday for Options Oddities on the pro side. Then back again next week, another great pro Q&A session. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.